Welcome to TalkTickers. You're joining us for a deep dive into the latest earnings call for FirstBandCorp. Our mission, as always, is to pull out those key insights, really give you a clear picture of their financial performance and what they're thinking about the future.
Right. So kicking things off with the headline numbers for Q1 2025. FirstBandCorp reported net income of $77 million.
Okay.
That works out to $0.47 per share. It's actually a slight increase from the previous quarter, which was $76 million or 0.46 per share.
So pretty steady then. What about return on assets?
Yeah, holding strong at 1.64%, a solid number.
Okay, steady start. But let's get into some of maybe the more dynamic parts. One thing that really jumped out was the net interest margin, the NIM.
Big expansion there.
Yeah, a really significant expansion. For anyone maybe less familiar, NIM is just crucial for banks. It's that difference between interest earned on loans and what they pay out on deposits. Higher NIM, generally better profit.
Exactly. And FirstBandCorp's went up 19 basis points to 4.52%.
Yeah.
That's quite a move.
19 points. Wow. So what was behind that? What drove such a big jump?
Well, a big piece of it was lower funding costs. Their expenses went down.
Okay. How so?
Specifically, interest-bearing checking and savings costs. They dropped 7 basis points down to 1.45%. And time deposits, like CDs, saw an even bigger drop, down 12 basis points to 3.39%.
Okay. So cheaper deposits definitely helped. Anything else on the funding side?
Yeah, their wholesale borrowing costs also decreased, partly because they paid off some debt earlier, so they got the full quarter benefit of that. And they also just borrowed less on average from the Federal Home Loan Bank. So, it looks like some pretty active management of those funding costs.
Right. Taking advantage of the environment, seems like they're navigating that margin pressure better than maybe some others.
Seems that way. They position themselves well there.
Okay, so that's the cost side, the funding. Now let's flip to the other side, the assets. What happened with yields on their loans and investments?
Well, the investment portfolio actually did better. Yields there increased by 11 basis points.
Oh, interesting. How?
Basically, as their older, lower yielding stuff matured, they could reinvest that cash at today's higher rates.
Makes sense.
Or even just holding more funds at the Fed, which pays more now. But on the loan side, the portfolio yield actually dipped slightly, just 2 basis points.
Okay. Why the dip there?
Mainly due to commercial loans repricing at slightly lower rates. It was somewhat offset by consumer loan yields going up, but yeah, a slight squeeze on the overall loan yield.
So earning more on investments, a tiny bit less on the loan book overall. Got it. What's the outlook then? What's management saying about NIM for the rest of 2025?
They're actually projecting continued expansion. They're forecasting another 5 to 7 basis points increase per quarter for the rest of the year.
Really? Even with potential Fed rate cuts maybe coming?
Yeah, they said that outlook does factor in potential cuts. They seem pretty confident in their ability to manage the margin.
Interesting. Any specifics on cash flow supporting that?
They did mention expecting about $260 million in cash flows from the investment portfolio just in Q2.
Okay.
They think they can reinvest that around 1.5% yield.
Okay.
And then for the second half of the year, another $1 billion expected, though maybe at slightly lower yields like 1.35% to 1.40%. Still, significant cash flow to work with.
Definitely. Okay, so strong NIM story. Let's pivot now to the loan portfolio itself. Growth. We saw a slight decrease overall in Q1, you mentioned.
Yeah, total loans ticked down just a little bit.
What was behind that?
It was mainly due to one large commercial loan being repaid in Puerto Rico. So kind of a one-off event, it seems.
Right. So not necessarily a sign of slowing demand. What's the outlook for loan growth?
No, they said the pipeline is healthy, and they actually reaffirmed their guidance for mid-single-digit loan growth for the full year. So they still expect solid growth overall.
Okay. And what about the funding for that growth? Deposits holding up?
Deposits look stable. Non-interest-bearing deposits actually grew by $70 million. And core deposits in Puerto Rico, if you exclude the government accounts, they were up $75 million. So, yeah. Seems like a stable funding base.
And are they expecting the type of loan growth to change much this year?
They are, actually. For 2025, they see more growth coming from commercial, construction, and residential loans.
Okay.
And they expect consumer loan growth, which has been strong, to slow down a bit.
So a bit of a shift in focus there, maybe playing it a bit more conservative, moving towards potentially less risky segments.
Could be shifting the mix, yeah. Focusing maybe on commercial, construction, residential.
All right, let's turn to credit quality now. Always a key area. We saw net charge-offs decrease, which sounds good, but the allowance for credit losses went up. Can you break that down for us?
Sure. So net charge-offs, the loans they basically wrote off as uncollectible. They decreased to 68 basis points of average loans. That's down from 78 basis points last quarter.
Okay, improvement there.
Yeah, but there's a little nuance. That number includes a $2.4 million recovery they got from selling a bunch of previously charged off consumer loans.
Ah, okay. So excluding that.
Excluding that recovery, the rate would have been 76 basis points. So closer to the previous quarter, but still technically down a hair.
Got it. So why did the allowance, the reserve for future losses, go up then by $3.4 million?
Right. The allowance increased to $247.3 million. Management said this reflects a couple of things. One, they're projecting some deterioration in the consumer outlook and also in commercial real estate price indexes.
Okay, some caution there.
And also just general economic uncertainty. They specifically mentioned potential fiscal policy and tariff changes in Puerto Rico creating some unknowns.
Right, the macro picture. Any specific problem loans pop up?
They did mention one specific loan moving to non-accrual status. It's a $12.6 million commercial real estate loan down in Florida, hospitality sector.
Okay. Non-accrual means they stopped counting interest income on it.
Exactly.
Yeah.
Though they did stress it's reportedly well collateralized. Still something to watch.
Anything positive on the credit front?
Well, early stage delinquencies in consumer loans actually decreased quite a bit, down $19.5 million from Q4. So that might suggest some normalization after previous increases.
Okay, so a bit of a mixed bag on credit. Lower charge-offs helped by a recovery, but building reserves due to caution and one CRE loan moving to non-accrual, balanced by better early delinquencies.
That sums it up pretty well. They're managing it, but definitely keeping an eye on the horizon.
All right. Now, let's look at capital management. How are they using their capital and returning it to shareholders?
They were pretty active here, too. Redeemed about $50 million in subordinated debentures, expensive debt, basically. Only $11 million of that left now.
Okay, cleaning up the balance sheet.
Yep. And they paid out $29.6 million in dividends. Plus, they restarted their stock buyback program.
Ah, buybacks are back. How much?
They bought back $21.8 million worth in Q1, and they expect to buy another $28 million in April. That gets them to their $50 million target for Q2.
Okay. And more potentially later.
Yeah, they still have $100 million left under a prior authorization that they could deploy in the second half of the year if they choose.
So dividends, buybacks, paying down debt, that all sounds pretty shareholder friendly. How did tangible book value do?
It increased nicely, up 7% to $10.64 per share. So yeah, those capital actions are boosting shareholder value on paper.
Good stuff. Anything else on the strategic front? Operational updates?
Yeah, a big one, actually. They completed their core systems conversion to the FIS cloud platform in Q1.
Oh, wow. That's usually a heavy lift for a bank.
Definitely a significant project. They called it a milestone in their digital transformation.
Yeah.
They're also pushing forward on data initiatives.
What does that core conversion mean, practically speaking? Better efficiency? New products?
Potentially all of the above, yeah. Usually leads to better efficiency, more scalability. It lets them, roll out new digital features more easily down the line.
Speaking of digital.
Right. They mentioned Apple Pay is still on track for rollout this year, along with some other digital enhancements they didn't detail yet.
Okay, so investing in the tech backbone. Important for the long run.
For sure.
And finally, what was the tone regarding the broader economy, especially in Puerto Rico, their main market?
Management definitely acknowledged some uncertainty there, specifically around potential new fiscal policies and tariffs, and what that might do to consumer confidence, economic activity.
So a note of caution.
A note of caution, yes. But they also pointed to some current positives.
Like what?
Like year-to-date government tax collections in Puerto Rico are actually up 3%, and the unemployment rate is still low. Plus, debit and credit card sales on the island were up 3% year over year in Q1. So some resilience there despite the policy noise.
So basically they're saying it's kind of too early to tell how these new policies will really play out.
Exactly. They're watching it closely, but the current data isn't flashing major warning signs just yet.
Okay. So let's try and bring it all together then. What are the key takeaways for you if someone's following FirstBandCorp?
Well, number one has to be that NIM expansion. It really shows they're managing the current rate environment effectively, both on funding costs and asset yields. That's driving profitability.
Right. Strong core performance.
Yep. Then you have the stable deposits, and the proactive capital management, the buybacks, the dividends, those are generally positive signals for investors.
Okay. What about the caution areas?
The slight dip in overall loan growth, even with the guidance reaffirmed,
Yeah.
and that shift in loan composition they expect moving more towards commercial, construction, residential, less consumer. It suggests a strategic focus, but worth watching how it plays out. And definitely keep an eye on credit. The increased allowance and that non-accrual CRE loan in Florida, while seemingly contained for now, they highlight potential risks, especially with that economic uncertainty in Puerto Rico they mentioned.
And the tech upgrades?
Long-term positive, I'd say. The core conversion, the digital push those investments, could pay off in efficiency and customer experience down the road.
Got it. Good summary. Okay, now for the fun part time for our This Is Not Financial Advice segment. Let's put on those speculative hats.
Right.
Based on everything we just discussed, what's an outrageous but plausible trade idea that comes to mind? Remember, folks, purely informational entertainment here.
Okay, how about this? The Puerto Rico policy paradox play.
Ooh, intriguing name. Go on.
So you've got this clear uncertainty the bank itself mentioned about new fiscal policies, tariffs, potentially hurting the Puerto Rico economy. That's the fear.
Right.
But you also have these current data points. Tax collections up, low unemployment, decent card spending, suggesting things aren't falling apart right now. Maybe some underlying resilience.
Okay, the paradox.
Exactly. The outrageous part is betting against the prevailing fear. Betting that maybe these policies won't bite as hard as feared, or the local economy just powers through.
And the trade itself, how would you structure that?
Well, the plausible part is how you might play it. You could go long, maybe a specific basket of companies, publicly traded ones, that get a really significant chunk of their business from within Puerto Rico. Domestic focus.
Okay, companies tied directly to the local economy.
Right. But because that's risky, you'd want to hedge. So maybe you pair that long position with a short position in something like a broad Latin American consumer discretionary ETF.
Why LATAM consumer?
The idea is if the Puerto Rico fears do materialize, or if there's just broader economic weakness hitting consumers across the region, that short position could offset some of your losses from the Puerto Rico specific longs.
I see. So if Puerto Rico outperforms the fears and the broader region, the longs win big. If things go south generally, the short provides some cushion.
That's the thinking. It's a bet on that specific Puerto Rican resilience relative to broader regional or policy fears. Definitely contrarian.
Definitely outrageous, but plausible. A lot of moving parts there.
Hence the name.
Indeed. Well, that's certainly something to think about. What stood out most to you from this call? Any questions still rattling around your head? We absolutely encourage you to do your own homework, dig deeper. That's what this is all about. Join us next time on TalkTickers. We'll be unpacking another key earnings call. And please remember, nothing you heard today constitutes financial advice.